Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena, I would like to talk about navigating decision paralysis. And this can happen in many sort of situations where a client might sell a business, do quite well and end up with a lot of money in their bank account. It might be as a result of being in an industry that's very fast or high growth sort of business, where they go from a very small business 1 year to 3 years down the track, they've got a business that is significantly larger and therefore the profit is also a lot larger. Could be a situation where a client receives an inheritance or some sort of windfall gain. It's really when things change very quickly, it can be difficult for most people to navigate. And there's a lot of sort of behavioral finance considerations behind this. It's incredibly normal. We kind of get used to, from a financial perspective, our views around these sorts of things are shaped by lots of things, our upbringing, our culture, the people that we associate with, our family members. And, if I say, what is a big business? And I ask 3 different people, I will get 3 different answers. To someone, a big business is something that turns over more than $100 million a year. For another person, it could be 10 million. And so those viewpoints and our preconceived ideas around these and our relationship with money can have then a really big impact on navigating some substantial changes in our financial position.
So I think the first step is to understand what the root causes are. And as Stuart mentioned, this is more sort of psychological than anything else. And, when you come into a large amount of money, which you might, never could have fathomed at one point in time, there's a fear of, making irreversible mistakes. It could all just go down the drain one way or another if you just make the wrong decision. So people are generally terrified of making a choice and they just feel that they're at a stalemate, and this fear itself becomes a risk. So, and add to that all the noise that's out in the media and the advice that's out in the media. You've got endless amount of now advisors that put in 1,001 sort of strategies as to how to build your wealth and what you can do. So there's a lot of noise out there from lawyers, accountants, financial advisors, family and friends, funny enough, who might have not have been as successful as you, still weighing in as to what you should really be doing with your money. And it creates a psychological displacement. You don't know what to do, how to identify yourself now. You're living one way previously and now you've got this, a large amount of money. How should you then now live? So it's really trying to understand what these root causes are and then trying to sort of regain control and form a strategy around what to do with those funds.
I think we can do it really in a 2-step process, Mena. And I think, bringing some logic and some systems and, evidence-based approach, if you like, to these decisions really give us some guide rails around making these sorts of decisions. I mean, the first thing to really think about is your investment philosophy, really. And maybe it's your philosophy around money or philosophy around money and your life and your goals. So you've got to start thinking about, what sort of returns you're looking for. If you're going to put that money to work, are you going to shoot for the fences and swing for the fences, I should say, and aim for, triple digit returns or something like that? Or are you quite happy to earn a reasonable return as long as the capital is somewhat not put at risk? How much is enough? Like if I put $100 million in your bank account and then ask you, would you like to earn another 10 million? Is it really going to change your life? Like, how much is enough? Do you really need to take any more risk? Or is it really more appropriate to try and de-risk a portfolio as much as possible? Not to the point where you're foregoing significant returns, but, sometimes we see clients talking about a particular opportunity, but when you ask them and dig deeper, they actually don't have a huge risk tolerance. They don't want to lose capital. They would prefer to earn 4, 5, 6, 7% per annum and their capital not be at risk. And sort of what are your non-negotiables? We talk about ESG investing, which is environmental, social and governance, which is really ethical investing, if you like. Are they a concern? What about liquidity? Do you want to have the ability to be able to sell all your investments tomorrow and go to cash? There's pros and cons associated with that. What about leverage, in terms of how much you're willing to borrow? So I think the way I would describe that is investment philosophy. And our investment philosophy at Pro Solution is really evidence-based. We think that if we only adopt strategies where there's overwhelming evidence that demonstrates if we had have used that rules-based approach over the last 1, 2, 3 decades, and we can measure what would the outcome have been, then we think taking that approach reduces our risk, because all we're doing is we've got a very repeatable process that has strong evidence that it's going to deliver the returns that we're looking for. And I would encourage people, I think that's really the best approach when we're thinking about particularly large amounts of money. You really don't want to, if you've been lucky enough to be in a position where you've had a windfall gain, you might have worked for it, but let's call it a windfall gain. The last thing you want to do is, not use that money wisely. And then the second step is really, it's a who question, not a what question. Quite often analysis paralysis or inability to make a decision really comes from trying to work out yourself what is the best outcome. Instead, I think when we're faced with these really complex problems, quite often we think complex problems need a complex solution. Not always. Sometimes the simplest solution can be the best solution, and particularly with respect to business, finances, money, investing, quite often complexity brings cost and it brings risk. Whereas if we keep it as simple as possible, but not too simple, quite often we have something that's really easy to understand. We can then understand the implied risk in a particular opportunity or investment, and we keep fees to a minimum as well, which is key. So it's a who question or a what question. You then need to build a team. That team could be an independent financial advisor. It should be a holistic accountant. It can be a lawyer on that team as well. It might be a property buyer's agent. It could be a commercial property buyer's agent. You need to think about, who on that team you need, what sort of expertise you need, because if we're going to employ an evidence-based approach, we really want to be able to use people that have deep experience, because knowledge is really important, but experience tells us when and how to apply that knowledge. And by paying for advice, if I go off to a lawyer and I seek advice, what I'm benefiting from is all the mistakes that they have made over their career. We all make mistakes, but also all the mistakes that their clients have made before they actually became clients. And that's the experience that I really want to leverage.
So following that two-step sort of strategic approach, you realize that it's not a technical problem, right? It's more emotional. So I'd like to touch on how to manage that sort of from a psychological standpoint. And by no means am I a psychologist or anything like that, but this is more so from experience in dealing with clients who have had this sort of paralysis when making decisions. So what we encourage these type of clients to do is, once they've engaged the right advisors around them and implemented a strategy, is to commit to reevaluation periods. Now, the worst thing you can do is monitor your investments on a daily. As an example, if you just reviewed your investments during the Trump tariff, period where markets have been shot, then you're going to panic and want to do a sell down. So, we're all about the long-term benefits, the long-term gains, a long-term view. But full well knowing that we still need to hold our advisors accountable. We need to have a periodic review, whether it be every 6 months, every 1 year, and establish what the market conditions are and how we're going to navigate those. We also encourage clients to time block decision-making windows. So basically, don't try to be too on top of your advisors. Don't be over their shoulders asking why this, why that. Put your faith in them. This is what they do day in, day out. As long as they're independent and you've established what you want to invest in and what your risk appetite is and so forth, then there's no reason for you to be watching over their shoulder. And sometimes it's actually good to name the fears explicitly. And sometimes we do that in our risk profiling with clients. We ask them, what are they really afraid of? What do they really have an appetite for? some clients, for example, might not like the share market. They've got a big appetite on property, something that they can see, touch and so forth. So once you've articulated that, you can work with your advisor as to sort of what you should be doing in terms of investments and how to build your wealth from there.
And I think that's really important, Mena, because quite often I think risk tolerance is really an education piece. So I think most people have the same sort of risk tolerance. That is, they don't want to lose their money, but they would like it to work as hard as possible for them. And as long as I'm sort of betting on sure things, if I can use that terminology, then I'm happy to wear through the volatility as long as, over decade periods of time, I'm earning 8 to 10% without taking too much risk. That's how I would describe most people's risk tolerance. And so when clients have a fear about a particular asset, a particular approach, whether it's borrowing, these sorts of things, quite often I think it's an education piece. I mean, the stock market's a good one. I don't like the stock market. It's volatile. I like property because it's physical. I can walk through it. I get that. But, if we're employing a evidence-based approach to invest in the stock market, I can demonstrate to you why it's not as risky as it might fear. So opening yourself up and communicating that information to your team gives them the opportunity to create that education. And the outcome could be, maybe it's not as risky as I first thought, or maybe, in fact, that is your risk tolerance and you just don't like it. Either way, no big deal, but they can develop a strategy that is coherent with that.
Finally, I'd like to actually ask clients what do they think the worst case scenario is as a result of these underlying investments. It helps them build confidence in terms of if, it was all doom and gloom one day, what are they really going to walk out with? Is it a 3-4% return instead of a 7-8% return? Isn't that somewhat better than just sitting idle, and the opportunity cost is actually a lot lower than that, actually in the negatives? So it's really important to sort of ask yourself all these questions to help you sort of guide through this sort of decision paralysis.
I think to sort of wrap it up, it's really strategy, not tactics. So quite often people think about tactics, should we go and buy this property? How much should we borrow? How much should we put into the share market? They're very much tactical decisions. It's the strategy bit that I think is the most important. And the analogy really I like to use is it's like going and building a house without seeing an architect first. You engage a builder, build me a 3-bedroom home. He could do that. He or she could do that quite easily. I mean, they've built lots of homes before, but they might build something that you don't like, that doesn't suit your lifestyle, that isn't appropriate. Whereas an architect will sit down and work out, okay, how do you live? What do you want it to look like? What are the key important elements? And he or she will then design a building that is going to hit that. Then you can take that design to your builder and they will then build it. And we think it's a very similar approach. Whereas, a financial planner that might execute a strategy will want to know, how much we're going to put in the share market, how much we're going to put in the property market. An accountant's going to want to know what structure and so forth. That's the plans, if you like. It's a strategic financial planner that's going to be able to develop that plan. If you like, they're like the architect. And that's the answer, I think, to avoiding this analysis paralysis is really by having a long-term vision and having a strategy that takes you from where you are today to that particular point or over the next few decades. And that strategy gives you a context then for making those tactical decisions like, okay, what am I going to do with the money this year? So hopefully that gives you just a bit of context around those sorts of situations where people have a significant change in financial position in a relatively short period of time. We find that is typically the best approach for them to be able to navigate that and work with their holistic accountant and financial advisor to ultimately build something that they're very safe and secure with. Okay, until next week, bye for now.